All right, so picture this. You've got this amazing business idea that keeps you up at night. You're ready to take the plunge. But then it comes down to file paperwork, and you're faced with the question, what type of business entity should I choose? I've been through this journey more than once as an entrepreneur, and I've guided many business owners through it as a wealth advisor. So I know this decision can feel overwhelming. And today I'm going to go through the pros and cons of each business entity in plain English. Before I do that, I want to make it very, very clear that this video isn't tax or legal advice. This is about education and information. You should absolutely consult with a tax and legal professional before making any official decision. Remember, I can't know your specific circumstances. They can. And even if I was working with you, I'd still say go talk to a tax professional, go talk to a legal professional, because that's just what you do in the situation. So my first piece of advice is exactly that. Talk to a pro. We'll get into the details about the types of professionals that exist to help you and who you might want on your team later in the video. All right, so why does the type of business you choose matter? And when we say business, we also, a word I'm going to use is entity, right? So it's an entity, the business entity. I want you to talk to a pro about how you incorporate, because it's a question that matters. Here are just a few parts of your business that change depending on the structure you choose. So number one, your tax situation, how much you'll pay and when. Different entities, but different business structures have dramatically different tax treatments that can mean thousands or even hundreds of thousands of dollars difference over the life of your business. Number two, your liability protection. Are your personal assets at risk if your business faces legal troubles? The right entity can create a firewall between your business and personal finances. Number three, how you can raise capital. Are you trying to bring on investors? Are you trying to grow rapidly like a startup? Some entities, some structures make it much easier to bring in investors, while others limit your options. And number four, your exit strategy. When it's time to sell or transition your business, your entity structure will significantly influence both the process and how much you walk away with. So let's walk through the four starter options I see new business owners considering. Something really important to note is that many new entrepreneurs don't realize you can just start, right? You don't need anybody giving you permission. You kind of can just start operating a business without formally registering an entity. When you do this, you're automatically operating as a sole proprietorship. You'll simply report your business income and expenses on Schedule C of your personal tax return. There's no separate tax filing needed to become a sole proprietorship. You can just begin. So there's some pros and cons to sole proprietorships in all these entities, frankly, but we're going to start here. So pros, super easy to start. Minimal paperwork and fees, maybe no paperwork and fees, right? Depending on the type of business you're setting up. Number two, complete control over all decisions. It's just you, right? You don't have any other investors or partners or anything like that. Number three, taxes are pretty straightforward and simple. There's a direct tax flow through to your personal tax return. And number four, no separate tax filing for the business. Obviously, there's trade-offs. So what are the cons? Number one, unlimited personal liability. Your personal assets are at risk. There's no distinguishment between you and the business. Number two, it can appear less professional to clients and partners, right? Like that's a thing. It's just kind of you as this person, not this separate business entity. Number three, the ability to raise capital as a sole proprietor is extremely limited. And number four, they can be difficult to sell because frankly, you're not really building business assets, you're building personal assets. And we'll get into this more later. So who are the types of business owners that sole proprietorships are best for? Well, freelancers, consultants, very small operations just starting out with minimal risk, and no immediate plans for significant growth or investors. So the second type of business entity we're going to talk about is a partnership. So when two or more people join forces, a partnership can be a natural choice. So what are the pros? Relatively easy to form, Number two, shared burden of starting and running the business. You have partners or a partner, right? So this is hypothetically a good thing. You have people to help. Number three, there's tax advantages, perhaps. Profits and losses pass through to the partners. They're not necessarily taxed at the entity level, at the business level. And then number four, flexibility in how you structure profit sharing and responsibility. So if this partner deserves, this sort of pay, and you think you deserve this sort of pay, you all can negotiate that. There's a lot of flexibility there in how you distribute profits. The trade-offs, the cons, partners have joint liability for business debts, right? So that's a thing. Each partner can be responsible for the actions of the other partners. So if your partner does some unethical stuff, you can be liable for that, or you probably are liable for that. And that's something to think through. Do you want to take on that risk? Number three, decision disagreements can create serious conflicts, right? So the world is full of partnerships forming and falling apart because working with people is hard, right? And working with people when you both see yourself as owners or whatnot is very challenging. Personalities conflict, goals conflict, wants conflict, all that sort of stuff. And number four, for partnerships, it can still be complex to value and exit that type of business. So where we see partnerships often is professional services firms like law firms, medical practices, consultancies with multiple individuals. But the idea is mostly in service professionals where multiple individuals want to work together without the formality of a corporation. So the third type of business entity I want you to think about is a limited liability company or corporation. This is the LLC, right? And the LLC is the increasingly popular middle ground that offers flexibility with protection for the business entity. So there's some pros here. Limited liability protection for all members. So 1 member to 100 members or more, there's limited liability protection there. Flexible tax treatment options, right? That's nice. There's a flexible management structure, fewer formal requirements than corporations. And then the last one, it can have different classes of ownership. And I think the thing with LLCs that I just point out is there's just a lot of flexibility, right? And certain types of businesses are going to really value that flexibility in terms of how they're set up internally, how they distribute compensation, profits, all that sort of stuff. Now, of course, there's trade-offs because there's trade-offs to every single business entity. And for LLCs, they can be more complex and costly to set up than a sole proprietorship. When you set up the LLC, now you're talking to an attorney and have drafting documents for the business. So that's going to be a little more complex and it's going to cost money. There's an administrative burden, is what we always say. The second one is profits for all active members are taxed for self-employment taxes, right? So the profits pass through and then the self-employment taxes are assessed on those profits. Number three, some states, California, have additional fees or taxes specific to LLCs. So once again, that's an administrative burden that you kind of have to think through. And then finally, LLCs can face challenges with certain types of investors if you're trying to bring on other investors or capital or whatnot. Now, there's one thing that I think is really important to point out, and that's the tax filing distinction. So it's crucial to understand that LLCs have different tax filing requirements depending on their ownership structure. So people often think of the legal structure and the tax structure as identical, and they can be, there's nuance here is what I would say. So a single member LLC or a solo LLC is treated as what we call a disregarded entity for tax purposes by default. So that means it's pretty simple from a tax perspective. You file your business income and expenses on Schedule C of your personal 1040 tax return. So just like a sole proprietorship, right? So pretty simple. This keeps the tax complexity minimal. So a little more legal complexity, but the tax complexity stays pretty basic at that level. Now, a multi-member LLC files as a partnership by default. So that requires a separate tax filing, which is called Form 1065, the partnership return, and issuing the partnership issues a K-1 to each member. So this adds tax complexity and administrative costs. Not only does the business have to file a return, then that gives you a form to add into your personal taxes. There's going to be cost and complexity and administrative burden to each step of that. So another thing to think about is that any LLC can elect to be taxed as an S corporation or a C corporation by filing the appropriate forms with the IRS. So this adds another layer of options and considerations. So we'll get into why you may or may not want to do that next, but just know that you can file that way even if you are a legal LLC. So for whom is the LLC best for, right? So we see this often with small to medium-sized businesses where owners want liability protection without the formality of a corporation, real estate investments, or businesses with significant physical assets or liability concerns. So the next entity to consider is the C corporation. And this is something that you're probably just familiar with because it's what we mean when we say that's a corporation, or I work for corporate, or whatever it is. So that it's the C corporation is the traditional corporate structure used by most large companies. So here's the pros: limited liability protection, unlimited growth potential with multiple classes of stocks. When we invest in the market or the stock market, we are largely buying into corporations, right? So attractive to investors and venture capital. These businesses have gotten so large because they've raised capital or earned capital, and they keep it and they get bigger and they have bigger earnings and all that sort of stuff. It's easy to transfer ownership, right? I can buy stock, you can buy stock, you can sell stock. This is easy at the C corporation level. And certainly C Corps can offer the broadest range of fringe benefits to owners and employees. What are the cons? Double taxation. So the corporation is taxed, right? There's a corporate tax assessed there. And then any dividends paid out to owners, those are taxed again. So we call that double taxation. And that's unique to the C Corp. Number two, C Corps largely have the most formal requirements and compliance obligations. So there's going to be lots of, kind of legal work and tax work and accounting work that comes in, or compliance work that comes into play when you have a C Corp. They're certainly more expensive to set up and maintain, right? So that's a trade-off. And then finally, C Corps can have less flexibility in some aspects of the operations. What type of business is a C Corp best for? We see these with businesses planning to raise significant outside capital, and they want to go public eventually, or they have plans of a rapid scaling, an eventual acquisition or sale, or something to that extent. So S Corps are a special tax status that can be elected by either an LLC or a C corporation. So this is where we get into that distinction between the legal entity and the actual how you file from a tax perspective, right? So why would they do that? Here's the pros. You still have limited liability protection, right? That's a good thing. Number two, there's now this pass-through taxation. So no corporate level tax. Profits are passed through to the owners. Number three, that can, because of how profits are passed through, that can lead to significant self-employment tax savings. And I'll explain this in detail in a bit. But that's a big benefit of S Corps. There's clear ownership structure with stock. And S Corps tend to be a good option for profitable businesses with active owners. They're actively working in the business, right? So what are the cons? Well, there's strict eligibility requirements, 100 or fewer shareholders, and it can be U.S. citizens or residents only as the owners. Number two, there's only one class of stock allowed, right? So not kind of A shares, B shares, whatever. It's just one class of stock. Everybody is the same type of owner. Number three, there's certainly more formalities than an LLC. And number four, must pay owners reasonable compensation before distributions. So you have to get paid like as a W-2 employee on a reasonable basis. And that can be hard to figure out at times. Because of that nuance, there's more IRS scrutiny on S Corps, right? Because they want to make sure that you're not taking advantage of the rules here. Makes total sense. And then there's this is a big one. There's inflexible profit distributions for multi-member S corps. So unlike partnerships or multi-member LLCs, S corps must distribute profits strictly according to ownership percentages. So you can't decide to give one owner more profit this year because they worked harder, or maybe they have more sales or whatever it is. Distributions must follow stock ownership exactly. So this can be a significant limitation if you want flexibility in how your business rewards the different contributors who happen to also be owners, right? So who are S corps best for? Profitable smaller businesses where the owners or owner are actively involved and seeking to minimize self-employment taxes while still maintaining liability protection. And they can be particularly advantageous once your business consistently earns more than you need for your reasonable salary. You can start out as a sole proprietorship or a single member LLC, getting taxed on Schedule C every 1040. And in the future, you can decide to file for an S corp filing. So this isn't something you have to decide right away. This is why we're running annual tax projections, or you're working with your tax professional to run annual tax projections and comparing, hey, would I be better off if I filed as an S corp for taxes? And that can be a year by year decision. Once you go S corp, there are some rules about when you can kind of come back, but you don't have to file that way right from the start. As an entrepreneur, here are some specific factors that you should weigh as you make your decision in coordination with your team, right? So growth plans. If you're planning to scale quickly and seek outside investors, a C corp or an LLC that can convert to a C corp might be best, right? Something to think about. Number two, there's this thing called qualified small business stock, which is hugely complicated in its own right. QSBS is kind of the acronym. And if you're starting a business that could eventually be sold for a significant gain, you should know that QSBS, Qualified Small Business Stock, Section 1202, offers potential tax advantages. So with proper planning, and if you meet specific requirements, C corps can offer the opportunity for substantial or even complete capital gains tax exclusion when you sell. This is super complex, and there's strict requirements here, but for the right business, it can potentially save millions in taxes upon exit. And that's why we say exit planning is something that we start right from the beginning. And I'm going to get into that next. So the exit strategy. If you're building to sell, your structure now affects your tax bill later when you sell. So C corps can offer advantages for certain types of acquisitions, including the QSBS benefits that we just mentioned. And all to say, it makes sense to see the end in the beginning. The other thing to consider is income needs. So the double taxation in a C corp would be problematic or could be problematic if you need to pull most profits out of the business for living expenses, right? So there are tax advantages from an income perspective to maybe some of the other entity structures and tax structures. If your business has significant liability risks, the stronger protection of a C corp could be worth considering, right? That's something to talk to your attorney about. Complexity tolerance. This is a really big one for, I think, a lot of businesses, and especially as you're starting out. Be honest about how much paperwork and formality you're willing to maintain. So non-compliance can invalidate your liability protection. If you're thinking through filing as a sole proprietorship versus filing as an S corp, you have to acknowledge that the S corp has a lot more administrative tasks you must accomplish throughout the year to make sure you dot the I's, cross the T's, do all that fun stuff to validate what you're doing there. There can be state-specific factors. So some states, as we mentioned above, have particularly high LLC fees. Looking at you, California. Or, on the flip side, beneficial treatment of certain tax structures. So that's something to think about too, based on the state you live in. Just to wrap this all up, this isn't black and white. Choosing a business entity isn't black and white. There is no quote-unquote right answer. There's a right answer for you and your partners, perhaps, based on what you want out of your business. So we just had you download a whole lot of information on these business, these different entities. And if you're confused, join the club. I think most people are on the different structures, and they're hard to understand. There's a lot of nuance here. This isn't a decision that you need to make alone. You just need to find the right team of advisors. So who are those people? Well, I think first and foremost, there's a CPA or tax advisor. They'll help you understand the tax implications specific to your situation and can model different scenarios. So I recommend all my clients have their tax professional create actual tax projections for each entity type that they're considering. So don't just rely on general advice. You need to see the real numbers for your specific situation, and maybe not even just in 1 year, but in multiple years. So the next person to have on your team, the next professional, is the business attorney. So the business attorney will consult with you, learn about what you're intending, learn about your intended business or your existing business, and they will draft proper formation documents and operating agreements that protect your interests. Then comes the wealth advisor, right? So wealth advisors like me help you see how these business decisions fit into your broader financial picture and long-term goals. So what I find with many of my clients is that this isn't just a one-time decision. As your business evolves, you may need to reconsider your entity structure, and that's okay. So that's why having an ongoing relationship with these helpful advisors, these trusted advisors, who understand both your business and personal financial goals, that's why this is so valuable. Start by getting clear on your priorities. Is it minimizing taxes? Is it protecting personal assets, attracting investors, or creating a sellable asset, right? Assemble your advisory team to help you make an informed decision. That's super important. We talked a lot about that. And then remember, this foundation sets the stage for your business journey. It's worth investing the time and resources and yes, money to get it right, right? Your business, we want it to be something special. Do it right from the start. If you'd like help evaluating your specific situation, my team and I specialize in helping entrepreneurs navigate these complex decisions. So reach out anytime. We're here to help you build a business that supports the life and legacy you want to create.